This is the story of Dan Moran. Dan is a student loan victim. Dan is 36 and a production editor at ATS Journals in Waterbury, Vermont. He will be represented by a koala. Dan attended 4 years of college and 3 years of graduate school. Each year, he borrowed the maximum amount in loans. The maximum amount increased each year he attended school. Dan was financing his education with some savings, grants, and lots of loans. After 7 years of school, Dan had overwhelming grants and loans. The more he borrowed in loans, the less he received in grants. Dan was making minimum payments and not covering his interest rates, increasing his debt every single month. Upon entering the job market, Dan had to take a series of blue-collar jobs just to pay his bills. After 15 years, the interest rates have caused his $40,000 in debt to increase to $60,000 in debt. Every week, Dan earns $500, but every month he has to pay $400 in loan payments. $39 of that is in interest. Because Dan reconsolidated with U.S. Department of Education before the historically low interest rates of the late 90s, he couldn't reconsolidate with everyone else. Furthermore, Dan can't file for bankruptcy. People with gambling and credit card debt can file for bankruptcy, but not those with student loans. Dan has been with his girlfriend for 8 years, and they own a home together, but they can't marry because, in the case of student loans, the borrower's spouse's income would be counted with theirs, and Dan's minimum monthly payments would increase to $800 a month. With fair student loan practices, Dan would have a much brighter financial future and more peace of mind.
Hi, I'm Joan Lynch. I previously worked for Meritor Savings Bank, where I was a department head, and I managed several different groups, including the student loan department. The first thing I would tell a prospective client about applying for student loans is to go to your university or college and talk to the financial aid department. Many of the colleges and universities have relationships with banks and other lending institutions that can help you through the process and sometimes provide you with a discount in the rate or points that they charge on student loans. Students should be very careful when they're dealing with different institutions. They should avoid any loans where they're not being given a chance to look at all the terms and conditions for the loan, meaning how long the loan is for, what are the fees up front, what interest rate is being charged, and how the loan is being paid back. And even if they can pay back the loan before the end of the date, or it's called a prepayment. What I would suggest is that you talk to several different institutions and definitely read the terms and conditions. I would avoid any loans where there are very high fees up front, or if the terms and conditions are so cloudy or not available to you that you would feel uncomfortable signing the loan. Well, one of the things that will happen is the fees up front that you pay will be very large. For instance, if you're borrowing $20,000, they may be charging several points or percentage points up front on that loan. A lot of times you start to pay the loan back and you think you're paying a $20,000 loan back, but because they've charged you a lot of points, maybe you're paying a $22,000, $23,000 loan back. Also, there are a lot of situations, even with the reputable companies, where you can go in and say, I can't pay my loan right now, and they will defer the loan. When they defer a loan, they don't mean they're forgiving the payment that you're making. They're keeping that payment still in mind, but they're also charging you interest on the whole outstanding balance of the loan. So if you're not paying it down, you're actually paying interest on a larger loan. And there's no such thing as a forgiveness on the loan. You will eventually have to pay it back, and the longer you wait to pay it back, the larger the dollar amount is that you'll end up paying, because you're paying accrued interest or interest that's being earned on that loan by the lender that for the outstanding loan for that time. I think that most reputable banks and loan companies or loan programs, many of the loan programs that are through the federal government, such as Sallie Mae, they don't intentionally try to confuse their borrowers. However, lending is not something that the normal consumer, especially a student, is very familiar with. That's why you should really sit down and ask a lot of questions. And again, I would stress, go to your financial institution and go to your college and university and ask them. One of the things that I would suggest is, if you have parents that are willing to help you out, it's always less expensive if you get someone with a long credit history to help co-sign on the loan. There are other ways to get lower interest on loans. If you collateralize your loan, such as a home equity loan, you can get a lower rate. Institutions charge a rate on their loan according to how risky they feel that loan is. So if they're making it to a student that has no job, not a lot of credit history, or maybe even a poor credit history, you're going to have to end up paying a higher interest rate. So there are ways to go ahead and try to minimize the amount of loans you have to make. Also, if you talk to your college and university, there may be grants or scholarships available that can help minimize the amount of loans that you need to borrow. The one thing I will warn potential borrowers about is many times many students will take programs through a company that they find out through a magazine or the internet, and be very careful because sometimes those institutions aren't necessarily accredited and they may be affiliated with disreputable lenders, so the whole experience could end up poorly. You could end up with paying a lot of money for a class or what you perceive as a degree that doesn't exist. And again, you're going to get scammed by the loan that you're actually getting from the company. When looking into student loans, remember to talk with your financial advisors because there are a lot that are available that are guaranteed by the federal government at lower interest rates. There are individual loans for the student where the student can borrow a loan, and then there are loans that the parents can borrow, the Federal Plus loan. So look for either a Stafford loan. Sometimes there are loans that are offered through the state agencies also. And again, because these are government guaranteed, they are at a lower interest rate. The banks who partner with these loans make lower interest rates available because of the guarantee. However, that does not mean that these loans should not be paid back. And in fact, if you don't pay back a guaranteed student loan, it shows up on your credit report and will keep you from getting credit as you move forward.